65% of Americans set a financial resolution this year. Here are the tips that actually work. The number one worry? Unexpected expenses. So let's start there. Right behind that lunches, inflation's impact on everyday costs and savings. Tip 1, build your emergency fund. This is the foundation everything else sits on. You don't need 6 months of savings right away. Start with just $1,000 to $2,000. Keep it in a separate high-yield savings account, out of sight but easy to access. Automate a small transfer every payday, even if it's just $20. Tip 2, follow the 30% rule for housing. Try to keep total housing costs under 30% of your take-home pay. If you're over that, shop around for insurance, cut utility costs, or compare rent in nearby areas. Tip 3, small credit score moves that make a big difference. For context, the average FICO score in the US sits around 715. That's considered good. If yours is lower, you're not behind, you're just earlier in the process. Here's an overlooked trick. Pay before your statement closing date, not just the due date. This lowers what's actually reported to the credit bureaus, boosting your score faster. Tip 4, take advantage of higher retirement contribution limits this year. The 401k contribution limit for 2026 is $24,500. If you're 50 or older, you can add an extra $8,000 in catch-up contributions. You don't need to max it out. Even a 1% increase in contributions compounds over time. Tip 5. If you freelance or side hustle, keep personal and business money separate. It makes tracking expenses and substantiating tax deductions so much easier. Tip 6. Let AI tools catch what you'd miss. Budgeting apps can now flag late fees, unused subscriptions, and idle cash automatically. Many also offer biometric security and fraud alerts, catching issues before they grow. Tip 7. You don't need to be completely debt-free to make progress. Every balance you eliminate frees up cash flow and builds real momentum. Pick a method. Snowball for motivation, avalanche to save more on interest. And if you use buy now, pay later, treat every plan like real debt. Track it closely. Tip 8. Consider a credit union instead of a traditional bank. They're member-owned and not-for-profit, which often means lower fees and better rates. Credit unions now serve over 141 million members across the country. Tip 9. Know what's changed in the tax rules for 2026. There's now a minimum threshold before charitable donations become tax deductible. You can also gift up to $19,000 per person this year without filing a gift tax return. HSA contribution limits are also going up, $4,400 for individual coverage. Mortgage rates are expected to trend down toward 5.9% by the end of 2026. That's good for borrowers, but savings account yields may drop too. If that matters to you, now might be the time to lock in a CD rate. Here's the real secret. Pick just one clear financial goal and write it down. The act of writing it down crystallizes intention and boosts follow-through. Review your budget regularly. It's not a set it and forget it exercise. You don't need a total overhaul. Small, consistent progress beats perfection every time. Even saving $20 a week adds up to over $1,000 in a year. If your situation feels complex, a quick check-in with a financial advisor can help. It's also a good time to rebalance your investments to match your actual goals. Quick recap: emergency fund, the 30% housing rule, and small credit score wins. Then, boost retirement contributions, separate your accounts, and use AI tools. Finally, tackle debt smart. Consider a credit union and know this year's tax changes. You don't need all 9 at once. Pick one, start today, and build from there. Follow for weekly breakdowns on where your money's really going before the headlines catch up.